Well, Jerry, thanks for coming on the pod.
Good to be here.
Excited to get into crypto regulation and wherever we go during this episode. But we always like to start with a bit of an origin story. And I think your story is super interesting in terms of why crypto, why become a lawyer and get into regulation. So yeah, we'd love to hear a little bit about that.
Sure. So, if you think about every market that's existed in the world, like tech-based or whatever, so go back to the old days of, pretty much anything. So the Skype guys and the sort of VoIP-based systems, they didn't apply for telecoms licenses in 500 jurisdictions at the same time. It was new technology, they wanted to test it. Now that's emerged into a completely regulated global space that we all sort of use WhatsApp to make digital-based calls. We're not using GSM that much. And that's frameworks, law, and infrastructure to allow the right markets to evolve. So, and there's loads of examples. So you probably remember the old days, the Napsters and the Pirate Bays and all of the file sharing based data. Now that's emerged into Spotify and Tidal and Amazon Music. Same base systems, infrastructure is the same. The concepts of decentralized file sharing is sort of how those businesses operate, but they're doing it in proper controlled environments. And when people talk about global adoption or adoption of the masses and all that good stuff, maybe you and I might have taken a bit of risk, but probably your mother and my mother wouldn't want to do that. They're only going to start to do that in sort of trusted markets, where there's a degree of trust and faith and security around the counterpart that you're using in the space. And I use loads of analogies, but the one that I probably use the most is the airplanes. So you and me, we get flights and stuff all the time. Would you put your family on a plane with a pilot that didn't have a license, didn't know what they were doing, hadn't been trained properly, hadn't gone through the years of training and assessments and all of that stuff? You probably wouldn't. So you do it because you have, again, trust in the pilot and his ability and the way the plane is maintained. And so the crypto space is the same. I saw it as a new emerging technology. This is back in 2013, 2014. And I was a lawyer by practice, always on the front end. So I was always called as kind of a frustrated entrepreneur, not entrepreneur in legal clothes or whatever you want to call it. But I wanted to help develop the right frameworks that could allow the industry to emerge and develop in the right way, and create that kind of secure, trusted environment. In 2014, everyone thought I was absolutely crazy and it was absolutely ridiculous. I remember those kind of first working group meetings where some authorities would send a police officer or an enforcement unit or something because they thought I was trying to do something really wrong. They completely missed the point. What I was trying to do was create the right environment for those businesses to operate. So that was a background and story. Yeah.
So I think what's interesting there is you talk about crypto being an exciting technology, or blockchain being an emerging exciting technology, and you took the leap before other people did. Why? What was it about blockchain that you thought was so exciting, and what could you see maybe that others didn't back then?
No, look, this is not even a blockchain-based story. It's a tech-based story. So in every, let's just call it technology of efficiency. Let's call it the concept of moving away from an internet of data where you're based in Argentina and you're posting news and someone in London can read it. Data being shared and information being shared through the internet was fascinating. An internet of value was a next step, being able to use the technology to transmit value mechanisms on immutable ledgers. So security of the data, security of the history, security of the execution, reduction of all costs that relates to that. That's kind of as a basic principle. I'm a hardcore Bitcoiner. So as a basic principle, that was, of course, we started then to develop into lots of other interesting things. But it was almost so obvious as to what it could do, and so much opposition. That opposition has narrowed and narrowed and narrowed over the years. But again, that's a story of technology. So ATM machines, when they were released and we could all use our cards to insert into the wall and take out £20 from a bank account, was absolutely opposed. Banks thought that was a lot of people thought that was completely ridiculous, and you needed to deal with a teller face to face, and you could only trust that person to have access to your bank account. Massive opposition. Same with online banking. So online banking is a principle. Access to your bank account through a computer was massively opposed by a lot of the big guys. So natural opposition is just a story of technology from the beginning of time.
I guess even if you go back to, I might get this wrong, but I think it was when people started having cards now.
Oh my God!
The banks were worried that people would just try and hijack the bank on a card. Right?
Absolutely. So, so you can see what it accomplishes and how it accomplishes, even if you just talk about really core basic levels of efficiency, simplicity, and cost. Plus, like accessibility, which is a whole other interesting sort of angle, but the concept of an open network, defining, and maintaining a value system that wasn't under any form of central control. Like you and me might earn, US dollars or sterling or euros or whatever, and that's absolutely fine. You're not sort of that concerned that the Bank of England are going to royally screw everything up and, introduce 500% inflation and, absolutely destroy the value of GBP, because you have a degree of faith in the Bank of England, the way that system is run. If you're based in most of the other parts of the world, you have a massive. There are lots of areas of the world that you have suffered that. So the founder of as an example, the founder of Xapo, where I work, was Argentinian by birth, and his family had lived in one lifetime 3 currency collapses. So that's a storage and lifelong of work being put into a savings account that was reduced to almost zero, very, very little. Not once, not twice. The third time was the actual government taking control and seizing assets on people's bank accounts to fund the state. So that the idea that there could be a value-based system that existed outside of any form of central control was also sort of not just romantic but very attractive. So there were lots and lots and lots of things. Plus, like, it's almost like you can't, when you get into any form of exciting new development of technology, you can't really like script the future. The exciting thing, same as the discussions today with AI, you don't really know where it's going to go, but you want to be part of that journey and you want to help form the direction that it can evolve.
Okay, and just to play devil's advocate slightly on the currency crashes, for example, we've seen sort of boom and bust cycles, if you want to call them, of crypto before. So how does the volatility of something like, I don't know, an altcoin or something else that isn't Bitcoin, or even Bitcoin itself in the early days, how does that compare to traditional currency kind of crashes?
Yeah, no, look, I mean, there are 2 important things to cover there. The first is that you cannot, people use the word cryptocurrency and apply it to everything in one sort of unilateral way. And they're like fundamentally different things that exist under that one umbrella of crypto. So you can't put a unit of BTC into the same unit of account as some form of altcoins, even obviously some forms of stable coins, some forms of mem tokens, some forms of NFTs, some forms of... There are many, many, many different forms of assets that work using blockchain technology. There are even some guys, or there are even some larger players in the space, or even some, I'd say, authorities or government authorities that say, we're anti-crypto, but we're pro-blockchain. And I always say to them, well, yeah, that's great, but if you use a blockchain and you have a unit of account on that blockchain that exists and operates, that is a cryptocurrency. So you can't start to distinguish, but you also can't merge them under the one same bucket. So that's very important. And then to answer your question directly, it kind of comes back to the question of regulation and frameworks and everything else. So once you get into the sort of $1 trillion markets, like the BTC numbers, it's very difficult for that market to be influenced and controlled by any single or group of counterparts. So if you look at the Bitcoin ecosystem, it's something like 71% owned by retail users around the globe. The big guys, I forget the numbers exactly, but the big ETF numbers with BlackRock, etc., total, I can't remember, it's between 5 and 7%. I could be wrong, but it's smaller brackets. So when you go to the altcoins, and if you've been in the space as long as I have, like smaller market caps are subject to gigantic levels of market abuse and influence and everything else. So if you have so in the olden days, post ICOs, you had the IEOs and exchange offerings, and there were lots of platforms that were basically, you come to me, I say that how much do you want to raise? $5 million. I issue $5 million worth of assets onto an exchange network, but the exchange controls, say, 70% of that. So they create like fake transactions and fake volumes, and they have influence posting about this going to the moon, and they have all these crazy things happening on Twitter, and they're creating a fake market that doesn't really exist. In the classic financial services world, that's totally illegal. That's like pure market abuse. In the crypto world, those rules didn't exist, or they don't really exist. So now they're starting to slowly come into place, and there are some frameworks that it's not top priority in many jurisdictions, but they're starting to create. But that is what creates more secure markets. So to answer your question, if you have very small market cap altcoin universes that are incredibly centrally controlled by price influencers or movers, you can be subject to both ways, giant spikes and giant drops, and that's one of these things that most people don't really understand. People tend to think that they're being educated by following enough, Twitter feeds and listening to enough commercial podcasts on people, generating the same message, but they don't actually look under the hood on lots of this things.
That's why we got you on.
I developed like the first market integrity frameworks for virtual assets. And
when was that? When did you start?
That was completed in, I'm going to say, 2020, 2021.
Okay. When did you start working on
maybe 22. So what happened was, and this gets a little bit more technical, but, so when I started proposing the development of regulation in the space, everyone thought it was crazy.
When was this?
2014. So then you have the FATF, the Financial Action Task Force, so they proposed a series of recommendations in June 2019, and that was the world. That was the FATF, who are not a regulatory authority. It's a let's call it compliance unit, saying virtual asset service providers need to be licensed or registered under a certain framework. So if they're conducting these activities, they need to operate under these frameworks. Those frameworks were more or less compliance focused. So in the UK, for example, you have the MLRS and the MLR regime. That is legally a compliance framework. It's not a regulatory framework. That's what's now coming into effect in the UK. And in most of the world, they looked to do that and define compliance as a standard for regulation. Why were they doing that? To meet the FATF requirements, to be shown to be compliant and not get into grey listing problems or money val review problems or anything like that. But my pitch back to jurisdictions and authorities that were doing that was, look, it doesn't matter how much compliance FTX had run on the account holders. If you don't have a governance framework, if you don't have a risk framework, if you don't have segregation of asset policies around customer assets and et cetera, it doesn't matter how much compliance you have. If they're a group of like drunk 25-year-olds running a multi-billion-dollar business, something's going to happen. So that and that's always going to be a question of time. So the reason I'm saying that is that when I started working on market integrity as a principle, that was recommended by the FATF, not in 2019, in I think October 2020 or October 2021. I always knew that was going to happen, was going to come. So I proposed it, put it forward. The jurisdiction of Gibraltar, small, nimble, fast, was the first to adapt that and introduce it as a regulatory principle. So what's happening? Some jurisdictions were very slow to adapt to that. Some aren't even really considering it yet. And that's one of the issues in the crypto space. It is one of the issues because in the classic financial services market, so you and me go and open a bank in London. Tomorrow we open a bank account in New York. The day after we open a bank account in Singapore. The day after we open a bank account in Sydney. All of the rules and regulations that apply to each of those are not identical, but there are lots of broad brush principles which are exactly the same. Let's just call it. It's not exactly the same, but there's a standard that you're never going to be regulated as a bank in Sydney unless you're operating under like really core fundamental principles. In the crypto world, it's totally different. So, banking, you might have a more or less flat standard. Crypto, you have as low as basic AML and compliance, or as high as full prudential oversight and supervision. But the problem with that is that consumers like you or your mother or the guy on the street, they don't know that, or they don't understand it. They might look at, firstly, where in the world is this company incorporated, because that gives me a degree of comfort, or they'll be influenced by social media and the quality of what it looks like. So if you go onto a super impressive professional website and you have a couple of influencers saying, man, this is the best platform out there, that's likely to win more business than someone actually going, this are the real operational standards that we're subject to, and these are the ways that we operate our business. Because consumers, like average retail consumers, don't do due diligence on a bank account or on a bank. They don't really do that. They might generally be aware or less aware, or see them as a football sponsor and be more comfortable with it, but that's it. And in the crypto world, they don't do that either. But in the crypto world, it's a much bigger risk.
I think there's still, even like with traditional financial services, education around stocks and shares ISAs or SIPs and traditional financial products that young people, old people, they're still trying to get to grips with.
Yeah.
So crypto is just another branch of that, but like you say, the frameworks aren't there or consistently aren't there across different jurisdictions.
Yeah, exactly. Exactly. And like we to give you like a sort of our own example, Xapo has been around since 2013. Whatever, a million BTC, whatever it was, in custody. We were building nuclear vaults in the Swiss Alps in 2014, where everyone thought it was crazy. We were developing frameworks around the world. All of the most complex bits of regulation in the UK, let's say consumer duty as a principle, which lots of people have managed. We don't apply that just to the bank. We apply it to the BTC layer of our business. So we're operating in a like supersonically high level. Plus, we're BTC only, we're BTC central. We don't want to expose ourselves to any markets that can do all of the crazy stuff that I'm talking about, because we're built as a platform to help people protect, store, and grow their wealth. And we have always believed, since 2013, that BTC should form a part of that. We're not saying that now in 2024. We've been saying that. We've been writing papers around the case for a small allocation to Bitcoin, 1 or 2% allocation to Bitcoin. We were writing those papers in 2015, 2016. When you say
allocation, sorry, from people's individual...
Yeah, so like we've always said that, like, I've said, it's the same message I would have given you in 2015 as I'm giving you today. If you have £100 of savings and you put, let's say, a 2% allocation to BTC, and the Bitcoin project succeeds in what it can accomplish, your 2% is likely to be worth a lot more than the 2%.
When you say Bitcoin project, do you mean just putting it into Bitcoin to grow?
I call about the Bitcoin ecosystem, the protocol, what it's built to do.
Okay.
I use the word project sort of in what it can accomplish. It's a long-term sort of goal initiative. It's not at the end goal. It's very far away from the start goal, but it's still developing. If it absolutely were to fail in some critical black swan event or whatever, and you've lost 2% allocation to your savings, it's not great, but it's not the end of the world. Now, if you'd listened to me in 2013, 14, 15, 16, 17, it would have been worth a lot more than 2% of your £100 of savings. But so long as it's held in a secure way, it's structured correctly, doing away with all of the risks that can exist around even pure custody as a service, and 2% is acceptable. So if you bought an Amazon share at the beginning of time, you've seen the volatility up to like 90%. If you bought gold, if you bought oil, if you look at the volatility rates of like copper from the last 20 years, You just look at it. Look at most markets in the world have been subject to, gross levels of volatility. But again, I wouldn't tell you or anyone to put 100% of their savings into Nvidia. But if you believe in the success of the AI project, could that make sense to have an allocation? I mean, yes. So BTC we talk about in the same kind of context. Yeah.
And going back to Xapo then, is that where Xapo comes in terms of ensuring that it's done properly? You allocate 2% and it's stored and done properly.
Yeah, it's so we it's not just so there are lots and lots of different complex things that people don't understand or don't really get into as sort of normal average consumers. So our objective is to help people, as I said, protect, store, and hopefully grow their wealth. So absolutely, security, trust, history, infrastructure, governments, all the pieces around how to build that and do it for the consumer in a truly, truly fair way. That is what we want to do and achieve. We also want to give those BTC that you own, we call it superpowers. So we were the first platform in the world to allow sort of a Visa issued card to be linked to your BTC. If you want to be able to spend it, you can switch that on, you can switch it off. If you want to sell your BTC, again, people don't really know or understand that. People don't look at sort of margins or pricing costs. So if you buy and sell BTC as a normal retail consumer on a retail platform, Revolut, just
that's my example as well.
The margins there on the buy sell are like 1.5%. So for us, it's around 10 basis points. So it's about 15 times more expensive on that transaction to buy or sell. But people don't tend to look at that. And I'm not saying Revolut are like this one-off thing. Lots of platforms operate in those kinds of layers. Even institutional platforms operate at 80 or 90 basis points. So we want to make it really, really simple, really transparent, really obvious, really clean, open and secure, and provide people a way to that. Plus, we are a bank. That's a massive difference to an e-money platform or a payments platform or a crypto registered business or whatever. So when if you sell BTC on your Xapo account, you hold USD on your bank account. So that's deposit guarantee insured. We have no debt. We have no lending facilities. It's narrow banking that's simpler. So it's ultra safe on the USD side of things. We're not deploying or using custom assets for anything. Ultra safe on the BTC side of things. And that's not for everyone because some people, young people, they might have £500 and they want to take as much crazy derivative risk as they want, and great, that's up to you. That's not what we do offer. People who operate in the crypto world who want to just come out of that in a natural, secure, functional way, then of course we offer that. But if they want to hold and protect those assets in a very simple way, because we're and I say this all the time to different people as well. There are lots of banks now that are exploring the space in lots of different ways. BlackRock and the ETF is very, very well known. The Bank of America CEO, I think, made a few statements around sort of stablecoin integration. Everyone follows the Genius Act in the US. We've been doing a lot of work over there as well. How banks can actually interoperate with the technology. I call it like a convergence of standards. So you have banking regulation and standards here, and you have crypto developing here. How do you converge to give everyone comfort to sort of unify those systems and create that sort of overlay that everyone has comfort with? All banks that are looking to do this, and these are big institutions. If you talk about UBS and you talk about, it's all public information, JPM, everyone's talking about it. They're all exploring and interested and doing different things, but they're banks with lots of history, lots of assets, lots of security, exploring a new technology. We're the other way around. We're a Bitcoin-based business. We're a blockchain-native business that's obtained a banking license. We're not a bank exploring blockchain. We're a blockchain with banking. So when we talk about, if you talk about people are talking a lot about stablecoin integrations and all that stuff. We've been in that for 3 years. So if you send me 5 USDC or 5 USDT, it appears as 5 USD on my bank account. So we've built stablecoin blockchain-based payment rails into your bank and out of your bank. People are conceptually talking about that and they're exploring things, but we already do that. And same when people talk about, I don't know, inflation and concerns around devaluation and all that stuff. If you have a savings account with us, so you have $1,000 of savings and it's generated whatever it is now, 3.7% or 3.5%, I forget. We pay that in BTC. So think about having had $1,000 in savings or $100,000 in savings for the last 5 years, receiving your 3.5 before it got to 4.5 or whatever it was in BTC. It's almost like a built-in inflation hedge. So it's a long-term proposition, but we are Bitcoin native. So that is why we have banking standards, but we believe in the value proposition of BTC. And that's what our customers want.
Is that the major difference if you're blockchain native entering a regulated environment versus not being blockchain native and being in a regulated environment? You are ahead of the game because you're already understand the convergence.
Way technically ahead of the game. Engineering, security, infrastructure, way ahead of the game. So I mean, if you talk about adding BTC, like banks are looking at ETFs because they're financial instruments, and that's a very different, very different to offering BTC. Now go a little step beyond that and think about Bitcoin yields. Like imagine Barclays trying to develop a BTC deployment layer that could create a secure yield in Bitcoin. I mean that's like, and then think about the L2s or whatever the Lightning network. So we're integrated with Lightspark for
and just for non-crypto people, L2s and
the layer 2 is like a functional layer of the Bitcoin network. So fast, simple, immediate payments happen on Lightning. With Bitcoin, there are transaction costs and there are time delays. It can be minutes, etc. So Lightning is that sort of efficient L2. So lots of banks or financial services platforms are trying to understand Bitcoin as a concept. If you ask them to start to explore, L2 fast payment integrations that can work in a way that integrate with a bank, I mean, that's like light years ahead. So we've already done that as well. Stablecoin integrations, we've already done that as well. BTC deployment yield options, we ran a strategy with our own assets for many years, wrapped that within a Bitcoin share price, a Bitcoin fund structure, BTC share price, BTC deployments only, BTC yields only, and that fund's raised like 4,000 BTC in the last few months or something, allowing people to put their Bitcoin to work and generate a Bitcoin denominated yield. Same with like lending facilities. We offer like collateralized, so lending against the value of your BTC. So again, I use it before superpowering your BTC. You want to put it to work, generate a Bitcoin yield, we offer that.
Okay.
You want to borrow against it, so release the value of the BTC in a US dollar currency, and we offer that as well as an integrated service.
And in terms of adopting regulation, the crypto industry adopting regulation, would you say most crypto exchanges, platforms, the bigger players encourage regulation because it allows for more mainstream adoption, or is there still apprehension from some people in the crypto world?
I think so. There is only regulation will open the doors to many different channels or flows that non-regulation simply won't allow. You will not have banking for crypto-related businesses in the UK is still a problem. There are caps and there are limits and there's this discomfort. It's a bit of a kind of quasi-unknown, and lots of different reasons can be given around that, and that can get complex. But establishing a regulatory standard so that there's comfort in the counterparty because you know that they're operating to a certain level. Yeah, I mean that absolutely is a way if the objective is to sort of integrate it to the world. There are absolutely principles of open and free networks, the pure sort of concept of decentralization, access to the market, that will forever forever oppose that.
Is that more of a cultural thing? Like we want to remain unregulated because it's a decentralized play? And
Yeah. Shouldn't be subject to any form of control. And as soon as you enter a layer of regulation, you're adapting the business and what this sort of structural concept is within the control of someone else, and that should never happen. That wasn't the way that this was built. It should have been always around an individual's access, not being subject to anyone's control, oversight, restriction, and that I understand that, and I'm always sort of that sort of in between guy of like, yes, I understand that as a principle. Yes, I'm a big backer of open networks versus closed networks, but you've got to get a little bit real. So as soon as you have whatever the DeFi concepts of the world are emerging and it's super exciting, what it can do and accomplish is absolutely fascinating. At the same time, if you have a totally non-AML controlled open global network, that's really wonderful in one sense that some farmers in Egypt can transact with whoever might be in surfing in Sydney. It doesn't matter. Open networks, that's fantastic. At the same time, the Taliban have access to it. North Korea has access to it. Every child molestation unit in the world, every drug trafficker, everyone that wants to put the assets to work and generate returns in uncontrolled open network environments can do that as well. Does that happen? And is the whole bad world? No, that's not happening. I'm not saying that it is, but if you speak to authorities, of course they're going to have that as a real concern. So the really innovative guys, the really innovative guys are saying, I believe in the concept of decentralized open networks, but I understand that there are all of these authorities and governments, regulators, etc. So I want to show them what they believe the risks are and how I'm going to control those risks. So of course there are analytics-based systems, there are on-chain compliance-based systems, there are lots of clever and smart using the technology metrics that you can use to show an authority how you want to create an open system, but not allow North Koreans to participate in that network. Or if it's an ultra-high risk-based address, that it can be restricted from participating in that network. You can do that, but the problem is, again, if you're speaking to the guys, the community, if those are not the rules, there's no law, there's no regulation that requires that. If you're like today, if you're pushing to do, not full compliance, but let's call it risk mitigated decentralized finance as a concept, a lot of people look, I know they're going to come back to me and say, it's amazing, Joey, but that's not what those guys are doing. That's not what those guys are doing. That's not what those guys are doing. If I do that, I'm going to lose 50% of the market share or 80% of the market share because no one wants to operate within those systems. So it's going to be a question of timing. So if that continues to happen and all of that ecosystem goes full, no regulation will ever apply, no standards will ever apply, I don't need to be worried about risk, I'm a technology infrastructure provider and I don't need to do anything, fine, they can take that position. I will tell you that eventually there will be a clampdown, there will be a massive allergic reaction to that, and that's not the way to develop standards. The way to develop standards is to have the discussions with the authorities, to be open, to be transparent, to listen to them and the risks that they want to address and show them how that can be addressed. That's how you merge into something that can work. Or there are lots of, it's been years ago now, but, CeFi to DeFi or TradFi to DeFi or whatever you want to call it, taking the principles of decentralized finance and how it operates, but put the compliant layer, put the regulated layer, saying, okay, Xapo, I'm just making that up, yeah, fine, that's wonderful that you can create that yield, but you're responsible. So you're the entry point to that market. The system can operate on a decentralized network, but there's an element of control or trust around the entry point. No one quite knows where it's going to end up. But,
I guess it's like a spectrum almost, similar to a political spectrum in the sense you like small government or you like big government, or
yeah,
and there's a community of crypto guys that maybe are totally against it. You've got some people on the other side, and then you've got the middle ground, and it's kind of an ongoing battle.
yeah, it is. But I'd say like in the olden days of crypto, which is not like 5 years ago. So you think about the ICO days, and you had like some like fascinating projects and really really smart people doing really incredible things, and there are lots of really successful projects and supersonic teams, amazing. But then there was a lot of the kind of bad stuff that happened around the same time. Then all the crazy enforcement actions, all the copy paste, all the abuse, all the white paper infringements and breaches, and all sorts of bad stuff happened. We ended up with a brand of the ICO being, oh my god, dodgy, global crowdfunding, all criminals like doing weird stuff, trying to raise fake money and create fake prices, and it created this brand. And every part of the crypto community will live that same kind of cycle. So if some parts of that community still believe that everything they can do is just fine, and it will end up having this sort of quasi-allergic reaction to it, and have these massive enforcement shutdowns and clampdowns and everything, and that's just not the way to. That's not the most constructive way to do it. That's what I think. So, but I understand it, and it's always a balance. And a couple of the examples I was giving before, similar one. I mean, Xapo was one of the founding members of the Libra DM initiative. Tried to do everything properly. Love it or hate it, people still talk about it as a Facebook initiative. It wasn't really. But anyway, not to go into any of that stuff. Was trying to do everything. There were like open college meetings, every authority, every central bank, every piece of feedback was adapted and implemented, and there was listening. There was massive licensing processes, initially in Switzerland and the US, always just comply, listen, adapt, comply, listen, adapt, comply. And it never got over the line. At the same time, if you look at the numbers, Tether guys, and all credit to them, we're not looking for like licenses or interacting with central banks. They were building a business, and they did it really, really successfully. So there's always that difficult conundrum in the sort of startup universe of saying, well, if I go full conservative, risk-managed approach to building a fully regulated business, jurisdiction by jurisdiction, massive cost, massive complexity, massive restrictions, lots of difficult pieces. If I go full tilt the other end of the scale, which is like, don't care about law, regulation, or anything, I'm just going to go for it, and one day I'll be fine, and that's fine. That's the kind of the risk weighting, and it really does exist across the full spectrum, from like crazy risky. I think that's a disaster, to crazy conservative could also be a disaster. And then you have this sort of ground of like interaction, discussion, listing, develop, standardization, like all of the good stuff.
And does that, two final questions, but one being, does that differ across different jurisdictions? So for example, how does the UK differ to the US and Europe when we think about that battleground?
It definitely differs, but it's not just the country or the authority that differs. Obviously, what happens on the other practical end of the commercial scale is that people who are building businesses and networks that operate on the internet. So your core sort of domicile doesn't really matter as much as it did before. So in the olden days, if you were, a hedge fund managed out of the City of London or New York, tick, tick. If you were a private bank and you're domiciled in Zurich, Geneva, or whatever, London, tick, tick, tick. In the crypto world, I challenge anyone to tell me the immediate country of domicile of every counterpart that they're dealing with, or if it makes a massive difference. it doesn't really. So what tends to happen is the businesses will do like jurisdictional assessments, and they will themselves look at, okay, we want to build this out, and let's look at how this is going to be seen and interpreted, to what standard, what the requirements are, is it in scope, is it out of scope, and where. And they might look at, I mean, forget Indonesia, they might look at, I don't know, Morocco. I'm just making countries up. And the UK can be one of those countries. It could be lots of parts of the Middle East. It can be lots of parts of Asia.
So it's an assessment on individual jurisdictions by the company.
Yeah.
And so therefore, if
it's not like the olden days of like, well, I'm domiciled in London, so now I need to look at all this stuff. They'll look at, well...
So it can go anywhere, is what your point.
It can go. It can
so
go. That's why it's so important for those jurisdictions to get that piece right if they want to attract the right business.
And so is the FCA is in the right step towards that with the income regulation?
Yeah, it is because it provides clarity, security, and all of the good stuff. The bad stuff is, bad stuff may be too strong, but so it's always about finding the balance between supporting innovation in balancing innovation with whatever we want to call it, consumer protection, regulation, and decent standards of security. So if you weight it too far on the innovation bracket, it creates a lot of risk, or maybe too much risk, definitely too much risk for an authority. But if you go too prescriptively the other way and you treat every form of innovative technology and business as a bank, you're also, this is not going to work, right? So where getting that counterbalance right is critical. If you go to, I think whatever the EU and the MiCA kind of example, extremely rules-based, extremely hefty, that's fine. If you're a big financial institution, you've been dealing with that for centuries, you have masses of capital teams. Does it support true innovation in a kind of startup environment? No, it doesn't.
The crypto platforms will decide to go elsewhere.
It does not support it in that way.
What about the FCA's application of consumer duty rules and bucketing crypto within the investment platform?
Well, that's heavy. That's very, very heavy. So there, the balance is going to be. I think the balance will be. There is massive value to being domiciled and regulated in the UK, no question. Is it worth all of these additional burdens and restrictions for some businesses? Like for us, I think that it would be, because that's what we want. Would it be the case for every startup and the small cap sort of? I don't think so. I think it's very, very prescriptive and very, very difficult for those businesses to comply. So who is the target market and what do you want to do? The UK, just the UK market, if you want to service the UK market from anywhere in the world, you're going to be caught by that framework. So it's creating a very protective layer around the UK. I understand why the authorities would want to do that. Is it the framework that all other emerging jurisdictions around the world will want to copy-paste? No, it won't be at all. And that it'll lead to... But that's the call that the UK has made from a policy perspective, I think, yeah.
Got you. Final question, we always end on this question. Someone entering crypto regulation or crypto law or whatever you want to call it, any piece of advice or anything you would recommend that they do?
Yeah, absolutely. I think there has to be like an openness to something new. So the way that a lot of lawyers and advisors tend to think is they operate within a system and infrastructure that they know and understand, and they try and plug and play new things into old frameworks and systems, and that's not the way to do this. So you have to have an openness to say, understand that that's what you want to achieve, and I understand what this regulation was built to do and protect, but it doesn't do it in the right way, and I want to formulate things in a new way that can address that but support that. So it's a very different way of thinking about frameworks, but I'm a definite believer that plugging new technologies, infrastructure, systems, and everything that's emerging into legacy frameworks is absolutely not the way to support growth. And that you have to have that ambition and openness in a way of thinking if you want to be successful in this. That's what I'd say.
Great. Great to end on that. Thank you very much, Jerry.
Good stuff. Thank you.